Welcome in the daily editorial in the Cornell Economics Report. Cory and I are chatting with Tim Iacono right now. The more I listen to what Tim has to say, the more respect I have for him. Not that I didn't have a lot of respect in the past, but I got to tell you, now that we have him on as pretty much a regular contributor, boy, I'll tell you, this is a guy to listen to. Yeah, check out his newsletter for sure. Go to our favorite sites section. There will be a banner in there shortly. If you click on that banner, you can get all the information you want about everything that Tim does. Tim, you made a comment off mic here earlier. You were saying that with what's going on back in Washington, D.C. right now, timing couldn't be worse for all the, for lack of better terms, irresponsibility that's occurring back there. You want to talk about that a little bit?
Yeah, one of the reasons the Fed decided not to taper their bond purchases last week was because of things happening in Washington. They didn't say it overtly, but they implied, fiscal troubles as a result of the continuing resolution and raising the debt ceiling, along with the budget cuts that were enacted earlier in the year, are a drag on the economy. And so, what's happened over the last 6 months or so, and you can see it really developing in the data now, is that the U.S. housing market is really starting to weaken. And that's only showing up now because there's a significant delay in, locking in loan rates. And it all arises from the Fed's taper talk that began back in May, which sent interest rates higher, which made it much more expensive for people to buy houses. And now Wall Street, with the big price increases that we've seen in housing over the last year or so, Wall Street, who has been a big buyer of houses over the last couple of years, they've been hesitant to buy even more. And so you've got this a number of events that are all happening at the same time this fall, with the economy, with fading consumer confidence in recent days, even today with the Consumer Sentiment Report, that makes this wrangling in Washington all the more potentially catastrophic for both the economy and financial markets.
So, Tim, are you saying that the housing market is in decline, as in housing sales are going down and prices are going down, or are you possibly even predicting another pop of a bubble here?
Well, what's happened is that, and you've seen this before over the years, is that you have this surge of sales and you have a surge in prices. The reason it happened this time is because interest rates went up starting back in May. You had the same effect when they had the expiring tax credit and a couple of other similar events. And so there's such a big time lag for all of this to happen. Interest rates began to rise back in May, and people who were sitting on the fence decided to buy, and that pushed up sales, it pushed up prices. Now, because there's a big lag in reporting, for example, existing home sales, and earlier this week the Case-Shiller index, you still see prices rising pretty sharply and sales rising. But that reflects activity back in May and June. The most recent data from new home sales, which is reported at the time that contracts are signed, we've had 2 months of sharply lower sales, and momentum is clearly downward. Pending home sales now, which is a very timely indicator, that's fallen for 3 months in a row. So you have this culmination of events with the housing market that, Robert Shiller referred to some housing markets as being in bubbles because, you have 20 plus % year-over-year price gains in places like San Francisco, Phoenix, Las Vegas. So there's a dual concern now of whether we have, housing bubbles in certain areas and whether the housing market is, in the process of rolling over.
Well, I got to tell you, it's all about location in terms of what's going on in real estate. I know that in some parts of the country, I know for a fact that real estate seems to be very, very strong. So the Seattle, Washington area being one of them. But I got to tell you, my wife and I live about 2 miles, to about 2 hours north of Seattle, right on the Canadian border. And I'll tell you, the real estate market here is very definitely, to call it a buyer's market, Tim, is the understatement of the day. I mean, housing values in our area, and we live in a very nice area, are down as much as 50%. So I'm not really sure how people can say, that, well, we're optimistic about the economy because housing sales are going up. Yeah, they're going up in some places, but certainly not all. Any comments on that?
Well, yeah, as you said, housing is local. We have a wide variance in performance from state to state, city to city. For example, New York City, the New York greater metropolitan area has seen only very modest, 3% price gains year over year. But if you look at the aggregate data, I think the latest data from Case-Shiller was that home prices are up over 12% from a year ago. And when you look at the national economy, you kind of have to look at the national, median home price index or whatever other national index there is. And most of those indexes indicate the same thing. As a whole, home prices are up 10, 12%. And, the thing that's really surprising is that in recent months, over the summer, when you had this buying binge from rising mortgage rates, is we saw some home prices rising at rates, faster than they did back in the bubble days of 2005, 2006. They're coming off of some pretty low lows in some areas, but still the rate of the home price appreciation in some areas and as a whole, that's what prompted Robert Shiller to warn about bubbles in the housing market.
Tim, what really gets me is we're talking about the housing market here, and yes, it has been going up, but we're all saying that, watch for it to come back down quite severely. And then we also look at retail sales, which have been down. Earnings season last quarter was bad. This quarter, we're expecting it to be bad. Consumer confidence, as you said, that came out today, also not doing well. Is there any positives out there in the U.S. economy that people can actually base this on?
Well, the manufacturing sector has been doing very well over the last 4, 5, 6 months. That's very cyclical. It was doing poorly earlier, and it was doing poorly early in the year when the rest of the economy was doing well. And so they seem to be out of sync, the manufacturing sector, with the rest of the economy. But that only represents about 15%, I think, of the U.S. economy. By far, it is the consumer, their attitudes, and the housing market and equity markets that are really going to drive the economy. And I think with this budget wrangling in Washington, people are really starting to, I think, lose confidence. I just read they had that poll on wrong track or right track for the U.S. government and the economy, and I was pretty surprised to see that the people who say that we're on the wrong track has risen from 54% in February, which is pretty high, to 60% in July, and then 68% this month. That's more than 2/3 of the people think that we're on the wrong track.
That's a huge number. It's a huge percentage, and I have to agree with all of those people who feel that way. Ladies and gentlemen, that's it for this morning. We're going to be coming back with some daily editorials here perhaps earlier this afternoon. We've got to get back to recording the weekend radio show here starting in about 5 minutes. That'll be up early Saturday morning on the satellite, so the stations will get it. You will also be getting it on this site. And listen for Tim Iacono to be on our weekend radio show. Tim, thanks, bud.